Today we're going to introduce revenue and expenses. Revenue is money earned from the sale of goods or services. So if we were talking about a gym earns money from selling memberships or maybe selling apparel or renting lockers or providing tanning services or a personal trainer. So again, revenue is money earned from the sale of goods or services. Now, a business also spends money in order to operate. Now, these costs are called expenses. So salaries or advertising or equipment repairs, okay? And these are costs that are associated with the normal operation of a business. Now, if we're talking about the expenses of the school board, okay, you have the teacher salaries, you have the janitor salaries. Those all represent expenses. Okay, equipment repairs, okay, again, is another expense. Now, in accounting, a company earns a net income if the revenue that the company earns is greater than its expenses. So, again, if revenue is greater than expenses, we have a net income. Now, if the revenue is less than the expenses, we have a net loss. Okay? So if we had total revenue equal to 3,000 and total expenses equal to 5,000, we would have a net loss of 2,000. And the brackets indicate that it is a negative balance. So we don't put a minus sign in front of the 2,000, we just put it in brackets. All right, now we're going to introduce yet another financial statement, and it's called the income statement. And only the revenue and the expenses go on the income statement. You're not going to see assets, liabilities, and owner's equity on the income statement, only the revenue and the expenses. Now, an income statement is a financial statement that records the revenue generated and the expenses incurred by a company over a period of time. Now, it's not like a balance sheet, okay? Because it covers a period of time, not a point in time. So that period of time that an income statement covers is called a fiscal period or an accounting period. Okay? Now, the heading of a balance or an income statement is a little bit different from a balance sheet because it covers that period of time. So our last line in our heading will be for the month ended or for the 2 weeks ended or for the 3 months ended, whatever the fiscal period is. That's what you're going to have to put at the top of your financial statement. Now, usually, or when an income statement's prepared, usually the largest revenue goes first, then the thing that makes you the next most money, then the next most money. Okay, for the expenses, you can put them in whatever order you want, so I'm not going to worry about the order of the expenses, but the revenue should be in the order that make the company the most money. Okay. Alright, so I'm going to show you an income statement right now. So again, it's going to answer who, what, and when. So in this case, we have an income statement for Polska's pool cleaning. Okay. Now don't worry about the word projected. Just put income statement and the period of time covered by the income statement, which in this case is for the month ended October 31st, 2001. So you have to put this little bit of information because it's going to tell the person looking at the income statement what the fiscal period is. Now, again, you're going to list the income statement's 2 columns, okay? So the revenue goes first. Okay, you're going to use that middle column to start, okay, and you're going to add these up to get a total revenue of $460,000. You can write total revenue there, but you don't necessarily have to. I know that this is a total, okay, For the expenses, again, you put them in the middle column, add them up, and in this case you get 12,250. Okay, again, you could write total expenses, or you can write total expenses or not, but notice that this total and this total are being subtracted from one another. So we have, in this case, the revenue is greater than the expenses, so we have a net income of 447,750. All right. All right, going back to our notes. All right, now a couple of gaps related to revenue and expenses. One is the time period principle. And basically it's a gap that states that a company should set and consistently use the same accounting period. And what it does, okay, it allows for comparison between fiscal periods. So if you set a fiscal period of or an accounting period of a month, you're gonna be able to compare different months, right? So instead of setting a fiscal period or making a financial statement for 1 month and then the next one making it for 6 months, you're not going to be able to compare those two financial statements. But if you always set a fiscal period of a month, you're going to be able to compare if the company's improving or getting worse from 1 month to the next. All right. Now, another gap or generally accepted accounting principle is the matching principle. And it's a gap that states that the expenses of one fiscal period should only be compared with the revenue of the same fiscal period. So you can't take the revenue from 4 fiscal periods, so let's say January, February, March, April, and then compare them with the expenses of, let's just say, January. So if you're going to show the expenses for one fiscal period, you have to show the revenue of the same fiscal period. Okay, so that's to protect investors. Okay, because they know if you're going to show the expenses of a fiscal period, you have to show the revenue from the same fiscal period. Now, the next concept is confusing if you don't follow along, and you basically have to understand it. Okay, now in accounting we use what's called the accrual basis of accounting, and basically it's related to when revenue is recognized. Now in accounting, the revenue recognition principle basically states that the revenue should be recorded when the service is performed or the sale is made, or in some cases the bill is sent, not necessarily when we get the cash. So basically we're going to record revenue when we perform the work or send the bill, okay? Not necessarily when we get the cash. Okay? Now, under this same accrual basis of accounting, when do we record expenses? We record expenses under the accrual basis of accounting when the cost is incurred. So when we actually incur, what's another word for incur? Generate the cost, okay? Or when we receive the bill, okay? So now that's what we're going to primarily use. Now what you have to understand is there is another basis of accounting. It's called the cash basis of accounting. And under the cash basis of accounting, it's opposite. So it's got everything to do with cash, not necessarily when the work is performed. Okay? So under the cash basis of accounting, okay, and it can be, this method can be used for income tax purposes in some cases. Okay? Under the cash basis of accounting, it represents revenue when the cash is received, not necessarily when the service is performed, okay, or the sale is made. And under the cash basis of accounting, we record expenses when the cash is paid, not necessarily when the bill is received or the expense is incurred. Now, this is going to make a little bit more sense as we get through the next example. All right. So remember, under the accrual basis of accounting, okay, revenue is recorded when the service is performed, not necessarily when the cash is received. Okay, so it's revenue when the service is performed or the bill is received, not necessarily when the cash is received. Or sorry, not when the bill is received, when the bill is sent. Okay, so let's look at services performed for cash is $1,000, and services performed on account is $500. Now, under the accrual basis of accounting, what's the total revenue? Now, it's revenue when the service was performed. So, was the service performed in this case? Yes. Was the service performed in this case? Yes. So, total revenue is $1,500. Now, under the cash basis of accounting, it's revenue when the cash is received, not necessarily when the service was performed. Okay, now what I've done is I've made, or the example has the same numbers. Okay, so 1,000 here, 500 here. Okay, and this is under the accrual basis of accounting, this is under the cash basis of accounting. So under the cash basis of accounting, it's revenue not necessarily when the service was performed. Okay, it's more important when the cash is received. So was the cash received in this case? Yes. Was the cash received in this case? No. So total revenue under the cash basis of accounting is only $1,000. Okay, so you'll notice that these two numbers differ depending on what basis of accounting I'm using. Now, we're going to primarily use the accrual, so just so you know that there is a different basis. Now, under the accrual base of accounting, it's an expense when the cost is incurred, okay, not necessarily when we pay the cash. So advertising paid in cash is $1,100. Advertising to be paid later is $1,200. What's the total expenses? Again, this one is an expense because we incurred the cost. This one is an expense because we incurred the cost. So in this case, it's $2,300. Now, under the cash basis of accounting, it's an expense when the cost is, or it's an expense when the cash is paid, not necessarily when the cost is incurred. So advertising paid in cash is $1,100. Advertising to be paid later is $1,200. Okay, so it's an expense when the cash is paid. So under the cash base of accounting, the total expenses are only $1,100. Now, how does revenue and expenses affect assets, liabilities, and owner's equity? We're going to find out that revenue increases owner's equity and expenses decrease owner's equity. Okay. Now, we won't learn it in this or in this video, but we'll see how it affects the balance sheet.